Hey, welcome back to YT Finance, and this is the channel where I went to business school so you didn't need to, and today we are talking about the top 3 penny stocks that could potentially explode and surge upwards of 500% in the year of 2023. We'll be analyzing this article and going over the author's credentials, and then I will add my own personal take on all of these companies mentioned in this video at the very end. So if you want more videos like this, remember to go and smash that like button right now, comment your thoughts down below, subscribe if you are new, and without further ado, let's jump right into today's stories. The author of this article is a CFA, or a Chartered Financial Analyst, and back in November of 2021, he wrote an article about 5 companies that he predicted would surge more than 100%. And out of the 5 companies he put in his portfolio, a couple of them were huge winners. For instance, shares of the biotechnology firm called Longevron, ticker symbol LGVN, skyrocketed by around 800% that same month after receiving a rare pediatric disease designation for a key drug. On top of that, one of his picks was an energy services firm called Enservco, ticker symbol ENSV, which jumped by close to 180% following March after Russia's invasion of Ukraine. Now, clearly, all of these penny stocks didn't work out. Only 2 of the 5 ended up working out, and the author makes it clear that these companies are absolutely laced with various risks. He also mentions that his other 3 picks essentially went nowhere, and plenty of his other predictions, such as his moonshot predictions of companies that could surge up to 500 to 1,000%, have gone absolutely nowhere. That's why he says that it's important to weigh your risk to reward and to tilt the odds in your favor when trying to locate stocks that have fundamental potential returns of a 2x, a 5x, or even a 10x return for your portfolio. By identifying penny stocks like this, you could have an enormous payday, but again, you're taking on a lot of risk. He goes on to say that 2023 is shaping up to be a promising year, particularly for penny stocks. He even says that he has identified 3 companies that could potentially rise 500% during the year of 2023. However, first they have to go through his quantitative profit and protection system for all stocks that are below $5. He essentially focuses on a strong corporate franchise and if these companies have overlooked very innovative technology. Of course, many firms actually will meet these 2 elements. However, he says that the ones that he has picked seem to be the most likely candidates for a surge of around 500% in their overall share price. However, he does warn again that investors should carefully consider these stocks before investing into them, so I would always recommend that you would do your own research. And then, of course, I will give my own opinions about each of these companies at the very end of the video. The first company that he highlights, which is a penny stock, is Diebold Nixdorf, ticker symbol DBD. This company currently trades for just $2.20, while professionals believe the company could surge at least to $3, and at maximum they could potentially surge all the way up to $5. Now, at first, this doesn't seem like a giant increase in their overall share price. However, let's see what model he uses to predict his own price target. If you're not familiar with this company makes ATMs, and they also operate a plethora of various currency processing systems, which make up a surprisingly stable franchise for this overall company. The company has been generating positive cash flow in all but the last 4 years since 1987, so overall, this could be looked at as a pretty good company. The company also has a backlog of work where 80% of its 2023 product revenue are already filled, which is pretty good. The management of this company plans to ship around 60,000 ATMs and 35,000 self-checkout units in the coming year. Again, this reflects very positively on this overall company. Shares of this company, according to the author, are trading at a significant discount. However, a recent decline in the euro's value, which is essentially like the European dollar, shaved off around $76.3 million worth of revenue in the 3rd quarter of 2022. On top of that, this company has experienced supply chain issues which have clearly dented their overall revenues. The company has decreased in their share price by around 84%, but the author thinks that this is a phenomenal company to buy cheaply at a discount. The company is only trading at 1.3 times their forward earnings, making this somewhat of a value stock, and on top of that, it's one of the cheapest firms on the United States stock market. The author author believes that if we project these revenues out to their future growth rate, the company has the potential to reach a $10 to $15 price target, which is substantially higher than other professionals' estimates. However, this author is a chartered financial analyst, so we do have to take what he says with some credence of authority. However, I would not only rely on analysts. Always make sure to do your own research, because these price targets are more like guides and not what the stock will actually achieve. Up next, we have another penny stock named Curate Retail Group, ticker symbol QRTEA, which trades for just $1.92. According to professionals, this company is already overvalued, because at minimum, the company could be worth $1.20 for the rest of this year, and at maximum, the company should be worth $1.90. However, let's see what the chartered financial analyst has to say about this particular company and why he's so bullish on it. He says that this company is a cheap firm with a significant business franchise, to where the company owns QVC and HSN. Essentially, the company owns TV channels that play in a plethora of different institutions, such as when you go to the gym, if you're in a hospital waiting room, or essentially anywhere that just needs background noises. Essentially, these particular institutions always put these types of channels on, and this is the company that owns those particular channels. According to the article, the channel is available in around 99% of all households with cable. So clearly this company is making a lot of revenue from these other institutions playing a TV for some background noise in waiting rooms or at the gym. Curate Retail has been beating their overall revenues since 2015, and that's despite the stock dropping from around a $30 price point all the way down to just $2. So clearly this could be looked upon as a giant discount from what the share price was previously trading at. The market right now values the company at just 2.3 times their forward cash flows and less than 4 times their 2024 earnings. Overall, professionals believe that this firm could generate as much as $730 million for the entire year of 2023, which is a lot of revenue, particularly for a firm whose market cap and whose overall capitalization is only valued at $770 million. If we use a discounted cash flow model, this would suggest that the shares of this company could be worth as much as $24 per share, which is significantly higher than what they're currently trading at for just $1.92, according to this analyst. However, I would like to chime in here real quick, is that when we use DCF models, they always have assumptions pre-built into the models. For instance, he could run a DCF model and then I could run a DCF model, and we could arrive at 2 different conclusions. But overall, the author does rightfully highlight that this company comes with a significant risk, and that the firm has around $6.5 billion worth of long-term debt, which is a substantial debt load for a company who's only worth around $770 million as of right now. But on balance, this risk could weigh out to a very decent reward for investors who are willing to take on this massive amount of risk for massive upside. Lastly, we have Ginkgo Bioworks, ticker symbol DNA, which trades for $1.85. The company, at minimum, according to experts, is worth $3, and at the highest price point, this company could surge up to $12 by the end of 2023. This is a Boston-based firm who is a leader in synthetic biology. Essentially, Ginkgo Bioworks uses technology to genetically modify various organisms, and it's learned to use organisms to create everything from nucleic acid vaccines to flavors and fragrances. The stock, of course, carries a large amount of risk due to this being a startup company. However, professionals expect revenues for this company to drop by 19% in 2023, but the good part about this is that they are anticipated to become profitable through operating profits by 2025. But with that being said, the firm generated $194 million from its current biosecurity segment alone just in the past 9 months. Experts also believe this company could make up to $550 million by 2024. The company overall is very well capitalized, in my opinion, because the firm holds around $1.3 billion worth of cash on their balance sheet, which would get them very close until the firm becomes profitable in 2025, according to their operating profits. Overall, the author says that the company could be trading between $8 to $10 in a short amount of time. So, for the company to jump from just $1.85 all the way up to $8 to $10, this company should at least be on a watch list. Now, before I let the author conclude, let me give my quick takes on all 3 of these companies. Honestly, I'm not impressed with either of the first two companies. Clearly, this is not the time to invest into either ticker symbol DBD or ticker symbol QRTEA. And the main reason for this is based on their current financials. Now, clearly their projections seem quite positive, but until we actually see the company bring in actuals, I'm not going to bet or waste money on just projections. I really want to see these companies bring in actual, very positive earnings reports and overall revenue, so I can wait for these companies to officially prove themselves. However, out of all three of these companies, I would put Ginkgo Bioworks on at minimum a watch list. Clearly, this does not get a buy rating or a hold or sell rating from me, but out of all of these companies that the author is bullish on, I would also be bullish on Ginkgo Bioworks, considering that the technology is absolutely insane. This company, in my opinion, probably won't start to pay off until after 2025, so if you're willing to hold this company for the long term, feel free to look into this company more to see what you think of it. But overall, out of the three companies that he highlights for penny stocks that could surge 500%, Ginkgo Bioworks would be my favorite from this particular list. In conclusion, he cites a Morgan Stanley analyst who warned that the S&P 500 index could fall by another 22%, causing very large cap companies to decrease. However, overall, he anticipates smaller cap companies like penny stocks to increase during this same time period. I, on the other hand, would disagree with him because normally when larger companies are falling, smaller companies will fall as well. At the end, the author reminds us that these companies are all extremely risky, and if they are not set to do well over the next 12 months, at least they could perform well over the next half decade, and that's what I would attribute to Ginkgo Bioworks. That company does have a 500% upside potential over the next decade, but overall, these are all extremely risky companies that I personally would never recommend because the risk to reward ratio just isn't there for me as of right now. Now, some companies that I am buying right now would be companies like Chevron Corporation, Lockheed Martin, Costco Wholesale, Rio Tinto, Apple, Newmont Corporation, and not Ford. I would not buy Ford right now. Even though some people really like Ford and GM, I would rather invest into electric vehicle companies like Tesla or even some of the Chinese EV makers like BYD. I know Ford and GM are investing heavily into electric vehicles, but their stock price is just very stale and stagnant, so I would definitely continue to buy large cap companies such as Apple, Costco Wholesaler, Lockheed Martin, and the others on this list. So I would love to hear your thoughts down below about what you think of any of these companies. Subscribe if you are new, smash that like button, and I will see you in the next YT video.